Did you know that nearly 60% of Americans worry they won't have enough money to retire? This is a shocking statistic, especially considering that 1 in 3 people has no savings set aside for retirement at all. With pensions disappearing and Social Security benefits dwindling, it's clear that relying on Wall Street to secure your future is a risky gamble. Many of us have been told that investing in the stock market is the golden ticket to a comfortable retirement. But what if I told you that the reality is much bleaker? Wall Street is more focused on making profits for themselves than on helping you build your nest egg. As financial expert Robert Kiyosaki famously said, "The rich invest in time, the poor invest in money." In this video, we'll explore why Wall Street's promises are fading and what you can do to take control of your financial future. We'll uncover the hidden costs draining your savings, the dangers of chasing hot stocks, and strategies to become your own best investor. Get ready to change the way you think about retirement, because no one cares more about your future than you do. Chapter 1. The Retirement Mirage. Why Wall Street's promises are fading. For years, Wall Street sold us the idea that if we just invested in the stock market and saved diligently, retirement would be a breeze. But let's be real, that's not working for most people anymore. Pension plans are nearly extinct, replaced by 401ks that put all the responsibility on you. And it's not like Wall Street is too concerned. They've shifted their focus from long-term investments to quarterly profits. A recent study found that 40% of Americans fear they'll run out of money during retirement. Why? Because the old ways of saving and investing simply don't work in today's world. The days of company pensions, where you could count on a steady stream of income, are long gone. Now, it's on you to manage the ups and downs of the market, and let's face it, that's tough when Wall Street is more interested in boosting their bottom line. Here's a harsh truth. Wall Street thrives on short-term gains, not your long-term security. Share buybacks, quarterly earnings targets, and high-frequency trading all show that their focus has shifted. As Jack Bogle, founder of Vanguard, once said, "The idea that a corporation's first goal is to serve shareholders is a disastrous recipe for our economy." Chapter 2. The New Rules of Wealth. How the game has changed. Investing for retirement isn't what it used to be. The game has changed. If you're still following old-school advice, you're falling behind. Today, the wealth-building rules are different, and Wall Street isn't going to teach you the new playbook. One of the biggest changes? Market volatility. The stock market is more unpredictable than ever. A 2020 report from S&P Global found that the market is now 5 times more volatile than it was 20 years ago. This makes it much harder to build wealth for retirement using the same methods our parents did. And guess who benefits from this volatility? Wall Street. They profit from the ups and downs while leaving you to manage the risks. Another shift is the rise of non-traditional investments. Real estate, peer-to-peer lending, and even cryptocurrencies are creating new opportunities for those who are willing to look beyond Wall Street's usual offerings. Take real estate crowdfunding as an example. In 2023, it grew by over 25%, providing a way for everyday investors to get into the real estate market without buying an entire property. Wall Street wants you to think stocks are your only option, but that's not true anymore. As Tony Robbins puts it in Money, "Master the game. If you don't have a plan, then you're planning to fail." The rules of the game have changed, and it's time to take control of your financial future by diversifying beyond the traditional. Chapter 3. The Hidden Fees Draining Your Retirement Dreams. Wall Street's favorite secret? Hidden fees. You may not realize it, but these fees are quietly eating away at your retirement savings. And over time, they add up in a big way. In fact, a Forbes report noted that the average 401k holder will lose nearly $138,000 to fees over the course of their career. How do these fees sneak in? They come in many forms: management fees, trading commissions, and even fees for simply having your account. Actively managed mutual funds, in particular, are notorious for their high fees, often taking 1–2% of your investments every year. Now, that might not sound like much, but over a few decades, it's a serious chunk of your savings. According to Jack Bogle, costs matter. The math is simple. The higher the fees you pay, the less you get to keep. If you want to stop Wall Street from quietly siphoning off your money, consider low-cost alternatives like index funds and ETFs. These options track the market but come with significantly lower fees. For example, Vanguard's S&P 500 ETF charges just 0.03% annually, a fraction of what most mutual funds charge. That small difference could save you tens of thousands of dollars over your lifetime. One more thing. Watch out for financial advisors who charge commission-based fees. These advisors often get paid for pushing you into high-fee products that benefit them more than you. A better option? Look for a fiduciary advisor, someone who's legally required to act in your best interest. If you're finding this information helpful, make sure to subscribe. Stay tuned as we dive deeper into how to navigate your financial future. Chapter 4. The Corporate Cash Grab. Why Wall Street wants you chasing stocks. Wall Street loves when you chase after the latest hot stocks. The more you trade, the more they profit from fees, commissions, and market volatility. But the truth is, constant trading and chasing trends can hurt your long-term retirement goals. Wall Street doesn't care because they make money whether you win or lose. Take share buybacks, for instance. Over the last decade, U.S. companies have spent $6.3 trillion buying back their own stocks. Buybacks inflate stock prices in the short term but don't improve the long-term value of the company. In fact, some companies even go into debt to buy back shares. This is great for executives with stock options, but not so much for your retirement fund. Warren Buffett warns, when companies buy back their stock at inflated prices, it's like pouring money down the drain. Another way Wall Street keeps you chasing stocks is through short-term news and market hype. Every day, financial media outlets push stories about the next big thing. But investing based on short-term news is a losing game. A study by Dalbar found that the average investor underperforms the market by about 3% per year because of emotional decisions. The market will always have ups and downs, but jumping in and out only helps Wall Street, not your retirement. Instead of chasing hot stocks, focus on long-term investments. Index funds, for example, outperform most active traders over time and come with much lower fees. As Jack Bogle said, don't look for the needle in the haystack. Just buy the haystack. This approach gives you more control and keeps Wall Street from profiting off your fears and mistakes. Chapter 5. Decoding the Retirement Crisis. It's worse than you think. The retirement crisis is real, and it's worse than most people realize. Many are counting on Social Security or their 401ks, but that might not be enough. A 2019 survey from the Federal Reserve found that 25% of Americans have no retirement savings at all, and even those who are saving aren't putting away enough. The average 401k balance for someone aged 65 is just $192,877. While that might seem like a lot, it's far from enough to cover decades of retirement, especially with rising healthcare costs. The problem isn't just about saving, though. It's about the growing gap between what people think they'll need for retirement and the actual cost of living. Inflation is slowly eating away at purchasing power, and retirement might cost more than you expect. According to the Bureau of Labor Statistics, the cost of living has increased by over 50% in the last 20 years. And with healthcare costs projected to keep rising, your nest egg could shrink even faster. So, what can you do? First, get real about your retirement number. Tools like the 4% rule can give you a rough estimate of how much you'll need to save. The idea is that you can withdraw 4% of your savings each year and still have enough to last 30 years. However, some experts now say the 4% rule might be outdated due to longer lifespans and market volatility. A safer bet might be closer to 3.3%. Second, consider delaying Social Security. If you wait until age 70 to claim benefits, your monthly checks could be 32% higher than if you start at 62. That extra income can go a long way toward bridging any savings gap. As financial author David Bach says in The Latte Factor, the most important decision you make is not what you invest in, it's how long you invest. Delaying retirement could give your investments more time to grow. If you found these insights valuable, don't forget to subscribe for more tips and strategies on securing your financial future.